Good morning and welcome to part 2 of Real Estate Economics weekly webinar series. This particular week we're covering the greater Seattle area. This is part 2 of 4, so if you're interested in the entire series this week, please make sure you get all 4 pieces. In this particular section we're going to cover our 5-year forecast for this market area, starting first with building permit activity. As you can see in this particular area, we've had long-standing figures above 15,000 permits on an annual basis going back to 1990, a few peak years over 20. If you come forward to 2008, you see those periods or those permits drop off dramatically and tend to have been over-concentrated in multifamily product. Towards the end of this past cycle, the multifamily product was increasingly high rent, Class A, the higher density product oriented towards higher income people that quickly found or lost favor, found disfavor, if you will, as the economy had problems, and now the multifamily element of the permits going forward is going to shrink quite dramatically, at least through the trough, and maybe recover over the out years in the forecast. Here's our current employment totals for this particular market area. If you go to 2010, we're at about 1,377,000 jobs. If you look back in history or historically, that same total was pretty much in place on the ground in 2005 and in 1999. So what we really have is 10 years without tremendous job growth. There's a little bit of oscillation up and down. But in terms of really setting a base and growing on a decade-to-decade, year-to-year basis, that has not happened. This is a recurring theme across the country that many market areas have just not created the numbers of jobs that we need to put a extremely strong, firm base under the housing market. If you look at those numbers on a year-to-year basis, the 90s were very good. We had obviously some difficulty here in 2001 and 2002, correlates real well with the dot-com. Then we got some good growth in 04, 05, 06, 07. That rebound after the dot-com is not nearly as large as it is in most markets we serve across the country. This is an area that didn't have a tremendous overbuilding, a huge housing bubble. But really it's just recapturing some of those jobs from early in the decade. Coming into 08 and 09, this area is a little bit slow to come to the recession, which is a good thing, but the job losses in 2009 are pretty significant, continuing forward into 2010. If you look through the forecast period, the recovery, the rebound starts slow. Really next year is the first year of positive job growth for this particular market, and that's going to barely be a reversion to the mean, if you will. We're not reproducing a lot of those jobs. Many job categories and classifications are disappearing probably forever, and we're going to see increasing pressure on the public employment side, so we just don't have the tremendous job growth even on a 5-year basis that we'd like to see. Here's our mortgage rate forecast. Please note these are annual numbers, so they might not correlate perfectly with what's being quoted by the mortgage bankers or your current lender. You can see over the years mortgage money has become less expensive. There's been a lot of advances made in delivery of mortgages and streamlining the process so that mortgages are historically cheap. I think the big significant piece of data here is the 2008 to 2009 series, where when the credit crisis began, we went from about 6% all the way down to 5%. That has a tremendous impact on affordability, which we'll talk to in a later slide. If you look at the 5-year forecast, we've got rates increasing very slowly. I think this is playing out perfectly in sync with the weakness in Europe, and the little bit of softness we see in the Chinese economy is not putting a lot of pressure on the domestic interest rate, so rates are remaining very low. I think the mortgage-backed securities yesterday were at a low for the year, a low for 2010 as of yesterday. The increase over the next 5 years is going to help keep a little bit of lid on appreciation, which we'll talk to in a coming slide, but that's going to keep the house prices from really running away from us. That, coupled with not that great of economic rebound. We always like to talk to population growth in all the markets we serve. This is categories of ages, so the numbers that are negative here, the 25 to 34 and 35 to 44, that's just the numbers that are in that particular group from 2009 to 2014. So that category, it's not shrinking. There's just going to be less people in that particular group. It's not that there aren't any people there. That's still a real bread and butter group for house purchases, for employment, household formation, that sort of thing. Just we're not going to get that same level of growth in those categories, which really tells us watch your executive housing, watch your move-up product, but look to the 45 to 54, 55 to 64, 65 to 74 categories. That's where the huge growth is. If you're doing all-age housing, almost any place, we would encourage you to include single-story floor plans and include designs that are targeted for this mature buyer profile. This is a buyer profile that tends to bring equity, that tends to buy options, that tends to like premium lots and premium settings, and it's just going to be a source of tremendous demand over the next 5, 10, 15 years. That's part 2 of our series. If you're interested in listening to the entire group, make sure you get all 4. We'll begin part 3 in just a moment. Please download those. If you're interested in any of the information you saw in the previous segment, that's typically included in Real Estate Economics Residential Economic Report. We publish that quarterly for different market areas across the country, and we also do a series on age-qualified housing there. We'll join you in just a moment for part 3 of this week's presentation on Seattle.